Okay. Let's see what happens if we are live. We're live. I hear my voice.
Tom, can you hear me?
I can hear you. Yes, I can hear you. I see the little live thing next to you. I can hear you and I can see you. I can see you because you're right in front of me. I can hear you. All right. We're going to get this thing started.
Yeah, let's try this out and see how it goes.
Okay. Do you want to tackle the first question that Ashley put in there? Hello out there into I feel like today I was going to say into the into the internet, but I almost said multiverse. I don't know why. I'm reading too much stuff. Hello, everyone. So yeah, we're going to tackle a bunch of questions. We have some things that we wanted to cover with everybody today. If you have a question, you can throw it in the chat. You should see a chat below you. If you're using the YouTube feed, you should see a chat on your right. We can see those chat boxes. So if you want to throw something in there, this is your opportunity. Let's go. You want to start with the first thing?
Yeah, the sort of first thing. I think it's a pretty common one that a lot of people are asking, or maybe not even members, but a lot of investors are kind of thinking. And I guess it's with bidding wars and offer prices well above the asking prices, it's still possible to find positive cash flowing properties after all expenses have been counted in. So I forgot everyone could see this, but including if it's a HELOC, property management, taxes, insurance. I've tried earlier this year to purchase a property through Rockstar, no success. The math didn't yield any positive cash flow. So, and I remember speaking with Oz earlier this year too, and Oz, one thing you put in there is your HELOC, right? So I think if I remember correctly, you were looking at putting almost financing almost a 0% down, which obviously when you're not putting any money into the investment, it's going to be a little bit more difficult to get positive cash flow. So if you're including all those things, it does get more difficult, but it is 100% possible. We still see it. It's just more rare. Now, if you're putting more of a traditional down payment, then the options open up pretty wide.
I think with some of the duplex stuff, you can do it 0% down.
Yeah,
so I'll share some numbers.
Yeah,
so
okay, yeah. I was thinking the single family stuff as cookie cutter as straight as possible. Not even duplex stuff.
Yeah, got it. Even single family home, like the example that's Rockstar member purchased right now is $599,000. So it's a $599,000 purchase at 20% down and 2% interest. The mortgage carrying costs are $1,769 on that property. Then you have property taxes and insurance to cover on that. But the rent, they rented it out in St. Catharines for $2,600. So they're renting out a single family home purchased at $599, 2% interest, 20% down, 30-year amortization. The rent is $2,600. The mortgage is $1,769. So if we add on $350, that's cash flowing several $100. Yeah. So straight rent, we can find cash flow. But then the duplex, do you want me to share the duplex example now?
Yeah, you can share duplex, but there's student properties. It's just, there's so many options.
There's still so many options. They're hard. It's not like you can pull up to a street and find 10 of these things. You have to hustle to get them. There's no doubt.
Yeah, you got to have an understanding of what you're doing. But it's very possible. And it was possible before, when I was speaking with him in the past, it was possible then, and it might be tighter now. There's a chance it's going to get tighter again. So if you're really serious about this, it's you might want to look at doing it.
The thing that I think kind of startles everyone that we work with is that rents lag a little bit. So prices jump, and then rents kind of make it tough to cash flow.
Yeah.
But then if you let a year go by, rents kind of catch up. We never saw single family home rents in St. Catharines at $2,600. Just a couple of years ago, we didn't see $2,600.
No, you're right. And then we just shared with the team yesterday. And I don't know if this is the example you were going to share.
Yeah, I was going to read it out.
Okay, but this isn't even a whole house. This is one unit. So the upper level 3-bedroom of a bungalow is renting for $2,700. Now it's new and renovated and it's nice, but the rents have jumped. So a lot of people are using old rents from before, and they're using $2,200, and it changes a lot.
Yeah, and that's Hamilton, by the way. So this example, it is 2 units, top floor 3-bedroom rented at $2,700, bottom floors 2 bedrooms $2,345 for total rent of $5,045. The mortgage payment on this a month on this particular property at 20% down. This particular property was purchased for, I want to say $650,000, and this one was purchased about a year ago. So now you're into the $700,000. But listen to the cash flow on this thing. So total rent's $5,000 at 20% down on this particular property. The cash flow is $1,584 a month. So $1,584 a month. So even if you financed the renovation for the basement, $100,000 renovation, it would probably be more. If you did a full basement renovation to make it a legal second suite, it's going to be like $120,000. The carrying cost on that is about $345 on a HELOC a month. And if you borrowed your down payment to your zero down example, it's another $345. So we have like $700. When you're cash flowing $1,500, you're still then left with positive cash flow at zero down, everything financed.
And then you can add management in there, and there's still
and that's the bad example. The other example that I have rented out for $4,970. It's cash flowing for $2,479 because it was purchased slightly less. So $2,400 in cash flow. They put 20% down and were able to pay for the basement renovations to make it a legal second suite.
Yeah, and that's the difference, right? They put so on those numbers, and those numbers are less common. Like we don't see those types of numbers as often as we used to. But how they were able to achieve them was by putting in the sweat equity. So the work side of it to get the property to the standards to be able to generate those higher rents. That's what they're getting the benefit of that now. So that's the difference. If you're going to go turnkey, the numbers might be tighter, but cash flow is readily available.
I wanted to, Frank has a question here. I just wanted to address. Frank, I see your question just about the news article where building permits are down. It's interesting that you're saying that. We have some stats that we're going to show at the October 16th event, where a lot of the headlines are showing dwellings under construction in Canada are way up. But when you dig into the numbers, a lot of those are rental properties or purpose-built rentals or condos. And when you look at some of the single-family home numbers, the single-family home starts have come down, Frank, to your point. Data. But it's kind of mixed in the media right now because you're seeing some headlines saying the new supply that's coming on in Canada is the highest since the 1970s. But when you dig into it a little bit, the single-family home starts really aren't there. Mm-hmm. So this is...
Frank's question was he was saying the building permits are down, and therefore housing market is going to drop. And Frank, I would say specific to this question. So
no, I was going to get there.
Oh, okay.
You go ahead. You go ahead.
I was confused. You were all over the place. Yeah, it doesn't make sense. That's not necessarily a leading indicator. I mean, there's a lot of other things to consider. So to Tom's point, you got to consider that, but then you've got to look at demand. You've got to look at what they're doing with mortgage lending and interest rates and that type of stuff. So I don't know if there's more context there, but based on the immigration numbers expected, so the population growth and the household formation growth numbers that are expected to come in, if the building permits are down in the areas that get the population, I would think that's actually a more bullish sign for the housing market. Now, some builders are not building currently because they might be taking their pedal off the gas a little bit and they just kind of want to see where things shake out. That's a potential. They might want to do that. But if you look at unsold inventory of new homes right now in the Golden Horseshoe area, the numbers are very, very, very small. So I don't see any concerns there. So I haven't seen that type of particular headline, but you would have to kind of combine it with more data to be of concern about the market itself.
And just to jump on to extend this further on why permits being down likely is a bullish sign for real estate. Some of the numbers that we're seeing on that are in that not only are building permits might be down on single family homes, but the listing inventory that we're seeing in Ontario year over year is down about 40%. So the amount of properties available for us to all purchase, the actual listings, are down about 40%. New listings coming onto the market are actually in line with historical standards for this time of year, but they're getting snapped up so quickly. When you look at the months of inventory on the market, it's 2 months or less. And for a real estate market to hit that balanced, or even for prices to start dropping, we need about 5 months or more of inventory on the market. And we have less than 2 months of inventory on the market. So when you just look at what's happening in Canada as a whole right now, none of the signs really point to real estate coming down anytime soon. It's kind of weird because when you see so much stuff saying that real estate can't come down anytime soon, it makes me think prices are about to come down.
Yeah, I think the way we're looking at it is any massive shift. And because the average price can come down, right? So let's say something happens, and let's say the stock market has, like real estate, it's just gone straight up, right? This type of stuff is not supposed to happen. It's kind of artificial based on monetary policy, all this stuff. So if the stock market gets hit, right, and there's some sort of correction in the stock market, using it as an example, well then one thing that we've seen in the past happen is that high-end properties around the Golden Horseshoe, so let's call it now, what do we call that price point, 2.5 and over, then the number of transactions happening in that world slows dramatically and slows quickly, because there's no need for housing for those guys. So they might like wait and say, okay, you know what, let's see what happens. Let's wait for it to recover. I just lost some money in the stock market, or the value of it went down. Let's see what happens. That might bring the average price down. That can. But just like during the pandemic, and just like we saw in 2008, the single family home market keeps kind of turning over at a different pace. So but that's the lower priced segment of the market. So average prices can come down and can fluctuate, but it doesn't mean that there's this huge market crash going on. Maybe something else dramatic happens, and there is, but based on just these numbers, you would need much more than that for that to happen, right? And I think that's where people, when the media talks about prices, they're using these average numbers all the time, which doesn't really matter. Like, you can't even use average around Southern Ontario or average in Toronto, because the average doesn't really matter. It really depends on what's happening in segments of the market with property type, and then segments of the city or whatever area you're looking at, and what's happening specifically there. And I think that matters most, and that's the data that isn't really, the data is very rarely presented like that in media, where all the headlines are, where people are seeing, and that's what causes sometimes some confusion.
I'm trying to think, what do you think, if you had to bet, what would it take for the real estate market to come down more than 15%? So like a $600,000 home goes down to, 510.
In like a quick manner, like relatively quick manner.
I don't know, whatever context you want to describe it in.
I think it has to be a lending issue. I think it has to be a lending issue, and there's not enough money in the system to keep things going. Because if I was going to see, or it would have to be some sort of drop in demand. Because right now supply is still very tight. We know that. Mm-hmm. So if demand dropped off,
demand's going to be there.
Well, look at COVID, right? There was a drop in demand for a period of time there, because and demand generally dropped overall if you look at the immigration numbers. But if you look specifically at like the March, April timeframe when COVID hit, demand really fell off a cliff. But that was a unique one because supply fell off a cliff too, because no one was selling their properties. There was much fewer properties on the market. So the balance was still in line. There were still property transactions going on all throughout that. We were doing transactions there. So, but I just think if like demand for some reason, let's say they changed the foreign students, the international students, the policies around national students, and made it much less attractive or much harder for any students to get status in Canada afterwards. Demand for international students to come to Canadian institutions would drop. Next year, it would probably drop a bunch. Mm-hmm. That could have an impact. Right now, there's no signs of them doing that, but I would say it's that. That's the most reasonable one based on recent things. I know, just
as I play this out, like the probability of them saying to foreign students, "We don't want you here," to me is really low. The probability of us reducing our immigration targets, really low. The probability of us increasing our supply in any major way, really low. It really comes down to lending. Yeah. Access to credit or the cost via interest rates is just super high. Like, to me, currently, that's the biggest risk.
Yeah.
And then interest rates we know can't go up, so I can eliminate that.
Well, they can.
I know they can. They can, but let's face it.
No, they have. Just recently, the 5-year rates have gone up. So when you say it like that, some people misunderstand, I think, saying,
in a substantial way. I don't mean a tenth of a point or quarter point. I don't even mean a full percentage point. I mean like 3 or more.
That could be a temporary thing as well.
Yeah.
Right? Because just like rates fluctuate. So if the rate goes up for a little bit, doesn't mean the rate can't come back down. Right? Mm-hmm. Those fixed rates. It looks like the variable rates aren't going to move very much, like the overnight lending rate. Now, the discount on them can change.
So the overall biggest risk to the entire real estate market in Canada is a global credit contagion where the banks in Canada stop lending.
Yeah, that's for sure.
That's the ultimate.
Well, because it impacts everything. It impacts far more than the housing market. And then all the impact of that is felt in the housing market as well.
There's no other, we can tackle some other questions, but it just still comes down to that. Like, nothing's really changed. That's still the biggest risk in the market.
Well, yeah. And the reason I say that, when we look at what's happened recently and we look for signs and why the risk might be low is because if you look at any government reaction to markets coming down in any meaningful way has been to pump more money into the system. So that's stock markets, or if the lending markets kind of start freezing up, they just pump more money into it to unfreeze them. So unless their policies change on that, then there's a difference. Like we were looking at some numbers for the event next week. I was looking at some trend lines and looking at the real estate market in the late 80s, right? And looking at some carrying cost numbers in the late 80s to see the ratios and compared to today. The difference with the late 80s is when things changed, the government would let things fall. They would let it fall. Whereas now we don't really see that happening. And I think that there has to be a wholesale change from the government to not just want to prop markets up and prop the economy up forever and let these economic cycles happen for that to happen. And maybe that changes today, but based on the platform that the Liberals ran on and they just got in, I don't see it happening in the near future. They might change their tune, but based on what they were saying just a couple of weeks ago, it doesn't look like that's going to happen. And that would need to be like almost a global central bank coordination to kind of change what they're doing.
So if the same trends occur over the next 10 years that happened over the last 10 years, the $600,000 property today in Hamilton is going to be worth $1.8 million at the end of this decade. How funny does that sound?
Yeah, if you're using multiples like that. But there is, but yes, but I think we've used a lot of the kind of
the easy way to pump the
powder.
real estate market's gone. The only things left are increasing amortization schedules and allowing that.
Yeah.
The interest rates can't go lower.
The interest
so that's
rates
a
going
dampening.
from super high down to low.
We're
that
at
changes.
6%. Now we're at like 1.99%. Yeah. Okay. Let's take it. Laszlo has a question here. Mortgage rates. Are people doing variable or fixed rates these days? What are the best today? I need to renew my mortgage. And then I think there's another interest rate question that kind of ties into this.
Variable.
Yeah, variable. We've always done the way we look at fixed rates, just so everyone's aware, you're buying insurance. Fixed rates are higher than variable rates. And to have that
Right now, sometimes they're not.
Sometimes I know,
Yeah.
I know. Sometimes there's an anomaly and they're not. But in general, fixed rates are higher than variable rates. And to get the security of having a fixed rate over 5 years, as opposed to the uncertainty of rates going up and down, you pay a little bit more interest. So to us, it's like buying insurance. So if you want to sleep at night and lock in your rate for 5 years, get fixed. But if you want to maximize kind of the current economic environment and you can live with fluctuations, then go variable. Nick and I typically go variable. I think we have like one fixed mortgage in the last 10 years, like total. Everything's variable rate mortgages.
Yeah, and one of the other big reasons that people don't think about initially, and I've talked to a number of investors who didn't think about this initially, and they're like, I really wish I did because it cost them a whack load of money, is that when you break a variable rate mortgage, I as far as I know, it's all of them, but I don't want to say all of them because I'm sure there's some that aren't like that. But any ones that we've seen, the interest, the penalty to break it has been 3 months interest. At such low interest rates, that penalty is very, very small in the grand scheme of things. So to break that is not a big deal. With fixed interest rate, with a fixed rate mortgage, it's an interest rate differential to break it. And the fees can be $20,000, $30,000 more sometimes. Mm-hmm. So it can be a lot to break that mortgage. And, so I like the flexibility, right? We like the flexibility. So it's just like, hey, you want to refinance the property? You break the mortgage, refinance it. You can access the equity easier. You don't have to pay these big penalties. There's all sorts of stuff you can do. So I think to me, that's just something that's not really accounted for. Everyone just looks at the dollar number. And I think it's like, well, you might be able to save some money. There might be some fluctuations, but you're also giving yourself flexibility. And if there is fluctuations, you can always lock in if you want to. It's easy to lock in after the fact. It's not easy to break it and go variable after the fact.
That's true. Everybody forgets that you can lock in. If you're on a variable right now, call your bank and just ask them what the process is to lock in rates so that you know. Usually it's signing one piece of paper. You're not going to get the absolute best fixed rate when you do that, but it's totally possible. And Laszlo says is getting 1.99 for a 5-year fixed, 1.99. Mm-hmm. Variable rate 1.4. You can actually probably do better on that variable. We're seeing prime minus 1.2, 1.25. So if you haven't pushed back yet, Laszlo, I would push back one time and say, hey, I'm going to talk to some other banks. Is that the absolute best you can do? We are seeing about 1.2. The lowest we've seen is somebody on the team got a 1.12 or 1.15. Yeah. On a variable. That was their rate, 1.12 or 1.15. So you might be able to push back a little bit on the variable if you wanted to. Nick, just on the interest rate thing, there was another question there. about Tony saying, what are your thoughts on mortgage rates? There was a news story about one of the banks increasing their mortgage rates. Yeah, so Tony, what's happened over the last little while is the fixed rate came down to 1.99, just like Laszlo's saying there. And then some banks are saying, we're going to pop it back up. And then that creates a headline. So like you have to kind of monitor these headlines in real time. So they came down like a week and a half ago. Now some banks are saying, maybe 1.99, our fixed rate's too low. We're going to put it back up a little bit. But in the grand scheme of things, they're super low. So some of those headlines are just all over the map because it's such short periods of time.
Yeah, and it's usually pretty small moves. So like interest rates rising, that might go up 0.1, 0.5, even 0.2. Even if it goes up a quarter point, it's relatively small in the grand scheme of things, unless there's a massive trend to really move things in that direction in a hard and fast way.
Yeah. Nick, there is a question here from Dima saying, is it true that St. Catharines market has slowed down in the last couple of months? Not from what we're seeing. So I don't know.
I was going to say yes because there's no inventory.
Yeah, well, okay. I guess there are multiple ways to say yes because there's nothing to buy. Yeah. But no, in that rents keep going up. And
I think it depends on what you're also comparing it to. So if you're comparing it to, however many months ago when there was
35 offers.
Exactly. Yeah. Then in that case, yes, it's slowed down. It's not like that. Do you still have to act very quickly? And are you likely to, do you have to put a strong offer in to kind of get the property? And are you likely to be up against maybe another offer? Those chances are still,
we've got a couple recently with the team with no competing offers.
That's true.
Which has been rare.
Yeah.
And purchased it at list price, of like what I would say is a quote unquote a fair list price.
Yeah. Yeah, so I guess compared to maybe the spring,
madness.
Yeah, so then it might have slowed down a little bit, but
is it slow where there's a lot of inventory where you can just kind of drive down the streets and find a property to buy? No,
the inventory. I don't have the exact number right now, but the months of inventory on the market in St. Catharines is quite low as well. So how you were sharing, Tom, that 5 months is usually more of a balanced market. It would be low. I'd be surprised if it was above 2, but I don't have the numbers in front of me.
Kevin is asking, is a student purpose built housing still a good investment, or is it better to go with a single family home and convert for students?
It's if you can, in my opinion, if you can get a single family and convert for students, I'm all for that because we've had some pretty good success doing that in the past. You're typically buying in that scenario, you're often buying a property that is not really maximized for the income potential. So you're buying it based on just the market value of the property in that area. And a lot of times that value is going to be lower than if you're able to then convert it and add additional rooms and rent it out to students. You're able to then increase the value of it as well. So if you're willing to do the work and you have the capital to do the renovations, I would prefer to do it the other way, convert for students, because I feel like you're often building in some appreciation that way because you're increasing the income potential of the property so much. That's my opinion, but sometimes those are hard. They're harder and harder to find depending on the area as well. But I definitely want to go that way.
It's easier to buy it already built.
It is, yeah, but they're often. It depends what you're buying. Often you're buying one that's already built and it still needs all the same amount of work as the single family one for students, right?
Yeah, totally. I'm only laughing because we've been there. It's rare, but you can. There are student rentals out there that are fully renovated that you can buy. I mean, we've been doing that kind of stuff.
Oh yeah, and some of our members, they do that purposely, and then they sell them, right, as an income generator. So,
okay, I've lost kind of my question threads here.
It's what are your views on pre-construction condos, townhouses in today's market? So that's Monica. Yeah, I
guess it's kind of like what you're, pre-construction. I think it's just whatever your goals are. In general, like we have a general answer on pre-construction versus resale that we prefer resale.
I'm all for everything.
Yeah,
like
same.
If you can buy a property and it makes sense, buy it.
If it's good, just buy it. It sounds like such a realtor answer. It's horrible. Oh, I just threw up in my own mouth on that answer.
You're right, but that's not even me talking to Monica. That's me just speaking for myself.
Yeah,
that's the
way
I
talking
look
about
at
buying
things.
assets. Yeah. But in general, our standard answer for that, we like resale because our money is working for us faster. Because typically you're closing within 60 days and you're going to get the property. Whereas pre-construction, you might be waiting a year, 6 months, a year and a half. If you look at the pre-construction we bought, we could talk about your townhome or look at the Blue Mountain property we bought, just got delayed until closing of March 2022. So now we bought pre-construction. We love pre-construction. We bought this pre-construction, but if we were going to rent that property out and get the money working for us, now we're delayed 5 or 6 months.
But then people will say to that argument, they'll say, well, it is working for you because it's appreciating in price over that time.
Agreed. The risk, okay, so that's something that comes up all the time, is that yes, if there's appreciation during that time, your money is working for you. However, what happens if the market collapses in the 18-month window from the time you bought the condo to the time you take possession? Because if that's the case, your money's not working for you and you're not liquid. You can't even get rid of it if you had to. You're forced to close on this property. So I know the probability of that happening is super low, but that's the flip side risk. So like as long as you're willing to live with that risk, it's like anybody flipping a home. You're putting sweat equity into this property to kind of flip it to make more money from it. But in the 6 months, 9 months, a year it takes you to flip the property, if the real estate market corrects in some capacity or goes down in some capacity, you're losing. So, I mean, like, it's kind of like higher risk, higher reward.
Yeah. And then, I'm always, I guess, thinking about some things that people don't always consider. But so right now there's 2 pre-construction homes that we purchased got moved from end of this year to next year, right? One's earlier next year, one's later next year. A friend of mine wants to refinance one of the properties we have together because there's a whack load of equity. There's probably, I don't know, there's a ton of equity in it. We've never refinanced it. We've owned it for 15 years or so. So he wants to refinance that. So now I have to consider these things when I have to consider the new construction before I can do that. So I have to worry about, well, how are we going to qualify for those mortgages on the pre-construction condos, especially if I want to refinance this now? So it reduces my flexibility as an investor because I have these commitments that are months or years out that I have to plan around. And sometimes I can't do certain things that I want to do because I have to think about closing on those or the mortgages or that type of thing. So that's the one aspect of it that I don't think is often considered, that can sometimes be a pain in the butt. And we've seen people even get themselves in a jam. They buy 4 pre-construction condos. They end up all closing at the same time. They're like, I don't know how the hell I'm going to get these mortgages. So it changes. So the pre-construction right now is a real thorn in my side because I have a JV partner that wants to refinance, and I'm all for refinancing, but I'm like, I can't. It's hard for me to do it right now because I don't know how refinance that impacts the next 2 mortgages that I need to be able to close on. After we close on those, I don't care. We can do it all day long, but those are the challenges. And we can just put more money down or whatever. There's ways around them, but it's nice to not even have to worry about that stuff.
Okay.
Did you like Joe's question?
Yeah, Joe. We asked Mike to walk around in circles in the office, so he keeps walking by.
Does it look busy? Good. That stuff's happening.
Yeah. Mike just left and turned off his light.
Oh.
Yeah.
Now it looks closed.
Yeah. The weird clock behind me is this weird clock, and that's what it's a mystery clock, Joe. It's a mystery clock. That's what the weird clock is behind me. There is a question here. I see Tom's asking a question. I can't get a refi on student rental because each room is a separate lease. How would you structure that? Tom, I once went a year and a half not being able to refinance a student rental for similar reasons. I had to get everybody back onto one lease. So I don't know if that's possible, but you might have to offer some incentives for the students to kind of rejoin onto one lease. But I just had to get everybody convinced that one lease was going to kind of serve their needs better. I forget what we offered. I don't even know if we offered anything. Maybe I bought them some pizza or something like that. I said, could you guys go on a lease? I was lucky that everybody was friends in the house. If there are a bunch of people who don't know each other, it's obviously going to be harder. But and in general, you want student rentals on one lease as you're learning. And then even then, most banks don't like refinancing student rentals. So you're going to have to try to figure out a way to incentivize the group in the house to get on one lease. Or when you re-sign new students in there, just go back to a group and sign one group, even if it means you're going to have a month or 2 vacancy because you're going to let people get out of the house at the end of a school year to be able to sign a group in there. But you need to get back onto one lease. An Ontario standard lease, everybody on one lease. There's no real magic answer there unless, Nick, anything's coming to mind for you.
Look, getting a mortgage on a student property is hard enough, and then refinancing one, like you're saying, is even more difficult because banks are even less interested in that because it's not new business, or I guess it could be in some cases. But you just got to be patient and stick with it. Yes, one lease will definitely help 100%, but you just kind of you got
no magic answer.
You got to keep trying.
You have to keep trying. You have to get to that one lease.
Yeah.
It's worth
but
it.
Not even the one lease. Like you just got to keep trying because you might one lease or not, there just might not be any options right now, but it doesn't mean that next month.
Yeah, and that's what happened to us. It was a monoline lender. None of the big banks wanted to refinance. It was a student rental by York University. Nobody wanted to refinance it. And then it was a monoline lender who mortgage brokers were working with who said, hey, we're open to taking on student rentals. And they were able to refinance. So after a year and a half of me trying, I finally got it refinanced. And get this, they forced me to take a high ratio mortgage. I had to go beyond 80.
I didn't know that to get the insurance.
Yeah, I had to go to 85% loan to value. They forced me to, even though I didn't want to take that much equity out of the property because they wanted it to be CMHC insured.
Yeah,
So they did a CMHC
That's smart on their part, actually.
Yeah, yeah, and they forced me to take more. I was actually happy to take it, but I wasn't even asking for that much. Isn't that crazy?
Yeah. I didn't know that part of the story.
Okay, I think we skipped a question or two.
Yeah, there was one about breaking a mortgage, and or that if the mortgage has a higher interest rate compared to the current market, how does that work? And that's where your penalties get really nasty because they will. That's where they calculate the interest rate differential, and it's basically based on the length of the length of the term remaining, the amount of outstanding, the amount that's outstanding on the mortgage, and the difference in the interest rate. So if you can get and they take the worst thing because they take like the posted rate from back then to make it seem higher versus a discount rate today. They take like the maximum spread possible, and they do some sort of calculation. It is outlined in your mortgage documents. I can't explain it now, but they figure out what you would owe based on how much revenue is lost to the bank by you breaking the mortgage. And that's why the penalties can get good. So in a scenario where interest rates are dropping, your penalties can get quite high. And what's strange is even in a scenario where interest rates rise, you can still be in for some interesting penalties because of the interest rates that they choose to use, which is like I don't know if it's posted versus discount or whatever, but they will find rates that are the maximum spread possible. So even if you have a mortgage and during that time some the rates have gone up a little bit, you could still be in for a little bit of a surprise when you go to break.
Colin had a question saying, which municipality in the Golden Horseshoe is most accommodating to accessory dwelling units or densification? Yeah, it's a little bit hit or miss. One of the more aggressive ones right now seems to be Welland, Ontario. Welland seems to be getting a lot of approvals through pretty quick, whereas St. Catharines kind of went in the opposite direction and said, we're just slowing down the whole process. So it's kind of hit or miss, and this answer seems to change almost by the every 6 month window. Yeah. But right now we're here.
Barrie's always been pretty organized from the beginning. Yeah. It varies, and then it will depend on the inspector.
It'll depend on the inspector. Yeah. So right now, I think that probably the two most friendly that we're hearing right now currently, and this could change, it would be Barrie and Welland.
Yeah. I don't have a recent update that I'm trying to think about in the KWC area because they weren't too bad once they got
and we're seeing Hamilton approvals get through. So we're seeing the other, but like just to try to answer the question on which are the most accommodating, I'm just hearing great things about Welland being very accommodating.
Yeah, I'd say the least is pretty unanimous around here in the St. Catharines.
St. Catharines.
It seems to be the least currently. Yeah. I don't know if that changes
Which kind of presents a lot of opportunity if you're willing to fight through it too. Nick, there's a question here. Let's say Casey question, then I think Dima has a question. I've been told that most banks appraisers will not consider the value of outbuilding such a detached accessory unit on a property. Thoughts on how to work around that? Casey, we're hearing the same thing right now. And I just think it's so early in the whole laneway housing, garden suites, any accessory dwelling on the property. I'm assuming that's going to change.
But the banks tend to lag. So I got to think in the next year or 2 years that's going to change.
Well, they have no comparables.
Yeah, it's tough.
Right? They need these things to be developed. And then they kind of need, it's for the appraiser to cover their butts. So the way the appraisers work is the banks have these approved lists. So, the banks are who feed the appraisers the business. So they don't want to take off the banks. And if banks want to make sure they're conservative, they need comparable sales to really value the property. And if they don't have these comparable sales because there's not enough of them, because some people are really just starting to add these detached accessory dwellings, and there might be a handful here and there. They might be old or they might not be in the area and that type of stuff because there's just not enough of them yet. It's going to really limit their ability to create some value there, and they don't want to put their butts on the line, because if they put their butts on the line and say, oh, it's worth this, and then something happens and the bank can't sell it for that amount because the person stopped paying and they have to repossess the property and they can't get their money back.
The bank doesn't call them back.
Yeah, the appraiser doesn't like it. So it's this kind of like domino effect that you got to consider with this type of stuff.
To flip back to Dima's question, what is a second mortgage, and can you buy a house with 2 mortgages right away? So Dima, a second mortgage is just an additional mortgage on the property. Typically, the first lender that you go to is going to have the first mortgage on a property. So if I buy a property and I go to TD Bank, they're going to want to be the first mortgage and in first position. If I get a second mortgage on the property, they're the second mortgage. It's just having a second mortgage on the property, and they're in second position. So if there's any problem with that property, the money goes to pay the person in the first position first, which is usually the first mortgage holder. And then it kind of goes down the line. We've seen properties, you can 3 mortgages. There's the odd one with 4 mortgages if there's construction loans and that kind of stuff on it. But typically, you don't buy a property with a second mortgage. Typically, you're buying a property, you could go to private money and get a first mortgage private money. We just saw one actually. Somebody just did that, Nick, on Monday. We got the interest rate on that. I think it was 6.8% private money, first mortgage. They bought the whole home at, I think it was 80% loan to value.
Something like that. I thought it was 5.8. It could have been around
5.8 or 6.8, something like that,
Yeah.
around the 6% range to buy it private money.
And the reason you often don't see the second mortgage is most big banks, they won't want, allow a second mortgage to be registered on closing. It's something you usually have to do afterwards,
closing.
right? My mind's racing now. I see Mike and Meg just asking, just mentioning there's a rumor the rules are changing in Barrie regarding garden suite approval. And I know it's a rumor. I'm just curious. I'm curious if you guys are still on listening to this. Do you mean they're getting easier, or they're going to start approving them, or what do you mean there? Because I'm just trying to get clarification, because we're seeing more and more people look to garden suites, and some projects starting to happen within the membership where people are starting to add garden suites to their properties. None that I can think of in Barrie yet, and that's why I was asking. And then this is interesting from Happy, to your point about Welland, that I received a permit in Welland for a legal duplex in just over a week after I applied.
Yeah, wow.
That's
good.
That's that's unheard
That's
of.
unheard of. Yeah. Yeah. Everybody run to Welland. I don't know what's going on with Welland. They just want to do development. Yeah, it just depends who's in power. It's like everything is just political, basically.
Yeah, they need the investment.
Mm-hmm.
Someone there has been like, hey, this is a way we can get people redeveloping properties. We can maybe get some population here, some people coming here. Someone there's aggressively trying to attract people, and that's how they're doing it. Whereas other people, other municipalities someone else is in charge trying to, for whatever reason, they have reasons why they don't want to be as accommodating.
This is exactly why no matter what what you think of the federal election and what policies go into place, it almost doesn't matter, because the municipalities don't change their approval process on a lot of this, because Mike and Megan are just saying they heard that it might require planning approval up to 1 year delay. Like, if the municipalities don't get involved in offering more housing options, how are we going to handle the housing supply issue?
Well, look, so here's what happened with the second suites, right? The provincial government, because municipalities, at first people were doing them, and then the municipalities clamped down on them in a big way. And remember, for a while in a number of municipalities, you couldn't have a second stove receptacle in the home, because they
remember that was in Brampton.
Yeah. So they didn't want them. And then because less and less were created, the Ontario government came down and then mandated that all municipalities put in some process to be able to allow these things. So there could be, because there will be pushback. There's going to be some people that if you're putting a separate garden suite in on the lot, they're not going to want that. The neighbors are going to be complaining. So there's going to be some hiccups early on in the process. But over time, if we need the housing units, I think they end up pushing it through. They'll just figure out a way to make it happen. And some municipalities are going to be, like anything, more open to it than others, and those are the ones that will get the access to it.
Hamilton's always been pretty kind of decent.
Depends on the area.
I know. There is talk now in Hamilton again of licensing student rentals. Did you see that?
Yeah, aren't they doing a trial now?
I think they're doing some kind of trial. So that's come back. Every few years that kind of comes back in Hamilton. So anyway. Okay, there was another question here, Nick. Cheap student rental insurance company.
Yeah, if you go on the Rolodex, I think our brokers are up there. You can
McFarland Roland.
Yeah, you can use that contact if you
want. A lot
want.
of people like Hub for student rentals.
Go to Hub, and it's just
but cheap.
We don't really look at, like, when it comes to insurance, we're not super concerned about a small difference in price. Like, and I don't mean that from
the right insurance.
Like we have we're just happily throwing money at the insurance. I just mean, like, get good insurance, because if something happens, the last thing you want to worry about is a a cheap insurer. You want to make sure that they're there. Most of them, the brokers are going to be using the same insurance companies anyway, so they're going to be similar, right? Hub kind of has its own program, so you can look at Hub. They're, I think, a little bit more expensive. They might have a little bit more coverage in some cases, but you can look at them. But you can check that out. Oh yeah, and then Joe said he uses McFarland Rollins and their service is excellent. We've always had a good experience. We've been there
thanks
with them.
for sharing that, Joe. Yeah, we felt the same way.
Our student properties have been through them, and they're brokers. I don't know who for a while it was. I remember the insurance company, Economical. I think for a while was actually the insurer. I'm not sure if that's the case anymore. I'd have to check. But we've been with them for a long time with our student properties. I don't know, so it's been good.
And then there was a question about other provinces. Colin, have you had any conversations with investors looking at other provinces? What do you think the appreciation in the Golden Horseshoe means for opportunities in Nova Scotia, I'm assuming, Alberta, over the next 10 years?
Are you asking me?
Yeah, I was going to answer, but I was wanting to see if you were going to jump in on that one.
I think it's good as long as there's income. They need jobs and income. So if the oil industry starts kind of pumping again in Alberta,
like it did in the early 2000s, mid 2000s, remember? We had people leaving him. I think we had a rent to own where somebody left the rent to own. It was a Rockstar member. They left the rent to own to go work in Fort McMurray.
Oh my God.
They walked away.
The numbers,
so we had people leaving Hamilton to go work in Fort McMurray.
Yeah. The number of interprovincial migration to Alberta from Ontario during those times was high. Yeah. Like it was strange, but they, not strange. It was just unusual to see, but it was very clear. There was jobs and income. So if jobs and income go to those areas, then the possibility for the real estate to appreciate in a faster way there is high. That's what happened because it's been decimated lately.
Yeah, and with everything going more digital, work from home, like let's face it, a lot of people are going to go back to the office, but there is going to be an amount that are working from home more than before. Maybe that extends out to allowing people to move back to Nova Scotia if they're from Nova Scotia and they have family there, or over to Alberta if you want the whole Alberta experience. So maybe these things kind of appreciate, but the way we would just look at it is just watch the population trends like Nick's saying. Just look at the population trends. And if you start to see uptick in Nova Scotia or Alberta population, that's an indicator to us that the property prices in that area are likely to rise. So we would just be watching the current state of population trends in those two provinces. And if I had to guess, I don't know. I just think there's going to be so much appreciation still here relative to those two places. It's tough.
Well, right now, because of the way that the population growth is and where the jobs are, it's very centric to this area. It's a strong hub for Canada, not dependent on one industry, right? Or the industries that are kind of like in Toronto. So like, let's say the banking industry is substantially more stable than the oil industry because it's not dependent on oil prices, right? The banks basically just make their own rules and they make their own money. So so there's those things to look at. A place like Ottawa, generally more stable just because of the higher number of government workers, and the government just kind of keeps them, the stereotype that you keep them employed, they keep paying them. It's like a slow and steady price increases. So it's looking at that type of stuff. But that's where I think Alberta's due for a kind of some good luck. I think some good fortune.
I feel like Alberta's been through the
ringer.
But
it's so dependent on. It's very dependent on that oil industry right now.
Someone was just asking here. What minimum and maximum liabilities do you need for house insurance right now? That's an interesting question because we just had Jerry Gatto here for a podcast and he surprised me a little bit. He said, just go ahead with $5 million liability because we had been telling everyone $2 million liability. And then he just came out and said $5 million liability. So if you want a legal answer, and we're not lawyers, but that's what Jerry Gatto, a lawyer, shared with us, that he was recommending $5 million liability. So that was new to us. I'd never heard somebody explain $5 million liability before.
Yeah, I think on the min side, I would say for a minimum, I would
$2 million.
Say $2 million.
Yeah,
right, and that's going to depend on the property, of course. If you're a multi-unit property with 15 units, and something drastic were to happen, I don't think $2 million is going very far. So it's going to definitely depend on the property as well. How much insurance you want there.
And Susan's did we already talk about that one? Susan's just saying, it's easy to obtain a building permit in Welland. Okay, there we go. Welland, easy place to get building permits. What industries are available in Welland? Where can people work to enable them to rent based on the current market rate? Someone was just actually giving me a list of the employers, and I don't have it in front of me. But what we are also seeing a lot of in Welland, it's the big commuter population. Mm-hmm. So that people are working in Niagara proper, or they're working in Hamilton, and then they're kind of commuting over to Welland. But that's interesting to get a list of the industries in these things. That's maybe something we could do on October 16th to kind of pull up some of the ones. Somebody just gave me one of those, so I can kind of hand it over to you. Were you going to add something there?
No, same thing. I think what's happened in a lot of those areas is as a lot of, I don't know if you've ever seen those kind of images we put together about the money dumping into like Toronto, and then the money, because the prices went up in Toronto, it caused the spillover effect, and people from Toronto went to these other communities and these other areas. And then as prices rose there, then people from those areas that may not have the same income as some Toronto jobs, they don't have the same affordability in those areas any longer. So then like people from Hamilton, as an example, would move out maybe to the Welland area, even though they could still work in Hamilton. So it's an area like Welland, although it does have employers, why we're seeing even stronger growth and kind of like above average right now is because of the whole kind of drive until you can afford something. And people in parts of the Niagara region or parts of the Hamilton region will drive out there for affordability that they can't get anymore in the area where they were living before. And I think that's all kind of comes back to the influx of population growth and money and things like that cause this kind of ripple effects along.
Tom's asking, do you have a specific recommendation for a property manager in the Niagara region? We get fairly good feedback about Orange List that covers the Niagara region. So that's one of the ones. So generally when it comes, the feedback we get back from Orange List is fairly positive. So that would be one example, but we have a few others if for whatever reason you've tried them and you want to try somebody else.
Hey Joe, that's interesting. Thanks for sharing that. Joe shared that he's got a $5 million umbrella, but it's the cost that's interesting. So it's only $250 per year for an umbrella policy over everything. So he's got $2 million policy on each of the units, and then a $5 million umbrella, which we have an umbrella policy set up on ours. I just don't know what the cost is and what the actual amount is anymore, to be honest. But that was interesting because the cost is relatively low. So if you own a few properties, you split the $250 over a few properties, it doesn't cost that much, and then you're in some pretty good shape with from an insurance perspective.
And Mark's sharing that Mike Moffat just released a housing report. Ontario will need 1 million new homes over the next 10 years to meet demand.
Yeah, well, the Liberals.
There you go. Good luck with that.
No, but the Liberals,
million new homes.
Yeah, but they're going to build 400,000 in 3 years or something.
3 years.
So
yeah.
we're going to be ahead of it.
Yeah, Mark, we get
in 10 years.
The government's got you covered.
They've got it all figured out within
Don't
10 years.
Don't worry about that. It's covered. These properties are coming. They're going to just plant seeds and properties are going to grow. Oh my gosh. The fact that we can so easily laugh at the government.
What did we figure out they were going to build them for based on their numbers? Was it 46,000 a unit?
I thought it was like $28,000 a unit.
Yeah, it was cheap. I don't know what they're going to, you can't even buy a car for that much. I don't know how they're going to do that. It'll be interesting to see.
Maybe they're just going to get blow up homes for everybody.
Maybe. It might be that.
And then you should plug it in and have
rope
a
ladder. It'll be like buildings with rope ladders at the side that you got to climb up or something.
Oh my God. We're only laughing because it's sad. This is not laughing out of humor. This is laughing out of sadness. Sammy's saying, oh, go ahead. Were you going to say something? Do you think there will be a negative impact to real estate due to the number of professionals leaving Canada or the GTA? Sammy, right now, we do not see a population decrease in this area, but we're monitoring. And it looks like any population decrease is going to be made up for by a population increase by the increase in amount of immigration that we get into the area. But it'll be interesting to see. We need a little time to see how those trends play out.
Yeah, we have some numbers that we'll share on that we're just putting together now on the 16th. In that update, that the number of people leaving Canada or the GTA really isn't that high. The ones leaving the GTA are only leaving to some other areas. But now the numbers have kind of reverted back in some ways as well. So we'll dive into that a little bit more. But there isn't this mass outflux of people leaving.
Outflux?
Yeah, I don't know.
Outflux?
I was trying to think. Maybe.
It's the opposite of influx. No,
50-50 chance. That's a word.
I understood you.
50-50.
Outflux. There is an outflux of people.
But there isn't like a stampede
there are
of people
going out.
area.
There are people going out of the province.
I say it's 50-50 chance.
There's
I gotta
outflux.
look this up.
I don't think there's a word outflux.
But anyways, it's actually not this huge group.
Maybe
of
there's an
people
outflow.
I want to see.
Maybe there's an outflow.
Outflow is what so look, just for the record.
Outflux?
It's just for the record. That's what I was looking for outflow, but outflux is a noun on dictionary.com, and it's the act of flowing out. Outflow. Outflow.
Outflow. Yeah, you just read the
outflow.
definition of
No, but it does say,
outflow.
no, outflux. Outflux. I think outflow is like a
Yeah, that's probably an urban dictionary of some sort. I don't know. We'll see.
on dictionary.com.
There was another question I wanted to tackle up here. Someone had. It was about the problem.
Oh,
you know,
this is very important now. Now we're this is an English lesson. No, it's on Merriam-Webster, man. It's legit.
Outflux?
Yep.
Outflux.
Merriam-Webster dictionary.
the
Yeah.
outflux.
The definition of outflux is 1, outflow, 2, outlet. So yeah,
Like it's an electrical thing or something. I don't know.
there. You're lucky. I taught you something.
No, I don't know what you taught me. I'm just now confused. I don't even know how to spell outflux. Flux? How's the end of outflux?
Well, it's no different than influx. I mean,
That's what I'm saying. I've never seen that word. What are you talking about? Someone was asking about the liberal housing plan. Are we going to discuss it up there? I don't know where that picture was. We have discussed that in other places. We will discuss that a little bit more, but there's not too much to discuss. On a high level, they want to build a lot of properties. That's not really managed by them. They can maybe work with the municipalities to try to get properties built, but we have no idea how the federal government is going to fix the housing problem based on their housing platform. They might build some federal rental property projects, and maybe that's how they can directly impact. I don't know how they're going to do that. They would probably have to go through the provinces for that. So it's a big mystery. Then they're talking about doing some more high ratio stuff, which I think CMHC just did announce that CMHC is going to increase the level or cap on high ratio mortgages from 1 million to 1.25 million.
yeah, that wasn't a liberal thing.
That wasn't a liberal thing, but the liberals did say they were going to
They're going to reduce the rate on some of the high ratio products, the CMHC insurance. They're going to reduce the rate of insurance, the cost of insurance by a quarter point or something small, which really is negligible, won't do
Yeah.
much. But that's bigger news. That CMHC
CMHC,
is saying
yeah.
high ratio, because until then, high ratio mortgages, any mortgage over $1 million couldn't be high ratio. They're moving that, not by a little, by 250 grand. So it's going from
25%. This is going to make the housing problem worse, not better.
Yeah, it will. It will. So and then the other thing the Liberals were doing, the other main one, there was like 2 or 3 other smaller ones, but then the other main one was that they were going to allow people, first-time buyers, to save to open a separate account that was not like an RRSP, and then you were going to be able to save for the property purchase through that account tax-free. Right? That was the other one. I think up to
That's right.
40 grand,
Yeah.
I think, something like that, with a limit. Which again, it's going to be negligible.
The only good things in the liberal housing platform that I don't even think they can do, where they were talking about getting rid of blind bidding. I kind of like it. Some people don't like it. If you're buying a property, you don't
like
want
it.
blind bidding.
If you're selling it, you might like
if you're
it, yeah.
selling, you like blind bidding because you don't want everyone to see the offers.
Yeah.
But the liberals are saying they're going to get rid of that. I think that's probably a positive because we've seen so many weird things.
Yeah, on
with
this side of the table
realtors
when you're
and-
dealing
yeah,
with it,
it's like blind bidding's probably good to go.
positives would probably outweigh the negatives.
Yeah. So even if I was selling a property today, I'd probably say for the good of the real estate market, blind bidding should go away. You should be able to see, I think. That one's it is debatable. Even if as I'm saying it, I'm thinking that's
You know what?
debatable.
I think you should be able to set your own rules. If you're the homeowner selling your property, you might be able to set. Shouldn't be able to set their own
I
rules.
like that. I like that.
Like if I want blind bidding, I'm saying, hey guys, it's blind
bidding.
If not,
Or
and
open the bidding up.
Yeah, and then if people don't like blind bidding, then me as the homeowner, I have less interest in
Yeah,
my
I
property
like that.
because of that.
I like that.
Like why not give the
Yeah.
option? Why mandate
choice.
it?
Oh my gosh, you're talking about free choice.
I just don't know why the government has to decide on everything. They're so stupid to
like
begin
that.
with.
I like that. But and then another one of their policies were some of the election platform was all about the real estate industry specifically. But the real estate industry specifically isn't governed by the federal government. So now the federal government has to get involved with like the Toronto Real Estate Boards, has to get involved with the Ontario Real Estate Association. So now we're talking about federal government trying to get their way into some of these associations to play their hand. So now
That's where my frustration comes, and I just called the federal government stupid. I don't know if I should have or not.
well, it's not even a political thing because we pretty much mean every single party.
Oh yeah. No, I'm talking to just the federal government in general. Oh yeah, it's not a political thing.
Blanket statement.
But it's just I've never, and maybe there are things, and I'm just oblivious to them, but very rarely does none come to mind that I've seen the federal government start mandating certain things and getting involved in a certain industry or a process or anything with a bunch of red tape in their decisions. And I've never seen it become better or smoother for the greater good. It just never works that way. Maybe the intent is there early on, but the way it's executed always ends up very, very poor. And I think that's where my frustration comes in. Like they kind of got to, they got to get their hands out of so much stuff and just focus on the core principles of things.
Yeah, so Eduardo, just to kind of summarize the federal election platform, there's nothing in it that we have seen that is actually going to bring down real estate prices and help people get into home ownership.
And I think that's
on the fringes, maybe it helps a little bit here and there, but in general, there's nothing that we saw there that was rather interesting.
Yeah. And I think they knew it as well, and that's why they didn't make it a main talking point of their campaign, because there really, if anyone dove into it, there really wasn't much there. You know, they really campaigned on the COVID stuff. They campaigned on other things that they didn't really kind of like blow the trumpets at their housing plan, right? Because if anyone dove into it, it's kind of a little bit of fluff.
I think housing as a percentage of GDP, I saw a chart that it's a full 10% of GDP. I don't know if you take into construction, like I don't know what they were taking.
It's higher.
So housing is just this massive thing. They don't want to mess with it. They're going to say one thing and do a different thing on housing. It is a little bit of a disaster. Evangeline's saying, yeah, making up words shows creativity, Nick. So there you go.
Yeah, you're lucky to have such a creative brother.
Joe's saying, Google bubble homes for some really cheap housing.
I did, yeah.
Yeah, so there you go. Yeah. You're going to get some bubble homes. That's what the federal government's going to put together, bubble homes. Go ahead.
No, there was one thing I was going to share. This was before, and I kind of slipped. Oh, yeah, there's some numbers. It just as an interesting side note, there were some numbers we're working on that we're pulling, and I'll share them in at the event, so we can pull them up. You can look at them. But it's very interesting if we look at home prices today, because I know everyone's kind of focused on prices because there's been such an acceleration in ticket prices. But when we took those prices and we took the monthly mortgage payment of today's interest rate versus the interest rate back to 1975 up to today, we took the interest rate, we took the average payment, and then we converted the payment. In previous years, we converted it based on the inflation calculator on the Bank of Canada website into 2021 dollars. The actual amount of the amount of 2021 dollars that it cost to own properties in like 1975, 1980 was, $2,300 around there, and then all the way up to 2015, because we did it in 5-year segments, it was only $3,100. And properties went from the average property in the Toronto Real Estate Board went from $46,000 to $497,000. So almost 11 times.
So to summarize that, you're saying that payments to carry a house didn't change much.
I was going to say that
property prices changed a lot.
Property prices went up 11 times, and payments went up by about $800. So at that time, it was less than 50%. So 1,100% increase in property prices, less than 50% increase in the carrying costs. And that's why prices, people don't understand how can prices be so high. That's why. That's what's doing it, because incomes have gone up that much over that period of time as well. So I'll give you just a quick example. It took 31% of the average household income in 75 to own the property at that price point. It took 37% in 2015. It's not a huge jump. Only in the last couple of years, and it was really ramped up because of COVID. Those numbers, and I'll share them. We're just kind of finalizing some of those numbers. I'll share those afterwards. But it didn't change that much.
So to keep the party going, interest rates could come down a little bit more, and the next card to play is extending amortization schedules saying, start with first-time home buyers and come out as the government and say, hey, to help first-time home buyers, we are now allowing 40-year amortization, 50-year amortization, go nuts, 100-year amortization. I know they won't do that, but 40-year amortization. And this is going to help first-time home buyers. And then 18 months or 2 years after that, when that doesn't help anybody, they'll come out and say, okay, everybody else, you're now allowed to do 40-year amortization schedules as well. Or the banks just quietly start allowing it beyond first-time home buyers or something like that. But amortization
I
schedules...
think they need authorization. I don't think the banks can do it on their own.
Yeah, who controls amortization length?
I think
the weird part is Genworth was still allowing longer when CMHC pulled it in.
I think the federal government has power over CMHC, but not over the private mortgage insurers.
You're right. You're not necessarily just the private mortgage insurance, not over the banks themselves, like you said, but the pressure, because just think how they work together, the pressure they would put on them to do
so. If the government, but I think the government's really going to loosen up on amortization schedules in the name of helping.
I think in the coming, I don't know when or by how much, I think it's almost a certainty.
If Japan is at 100-year mortgages as a possibility,
and we're at 25, 30, you got to think we're going to come 35, 40. next? Our next
we
step.
were there before. Why? What's the argument not to go back? And I know what the actual arguments are not to go back, but the political case is too strong.
Yeah, you just win votes.
Yeah, that's exactly what it is.
I'm going to lower the cost by extending the amortization, put you in debt for longer, but you're going to be able to buy a property, and that's all that really matters, and you get the votes. I think it's going to work for them.
Yep. Yeah, I'm convinced no one actually cares what they pay for the property. They only care what it costs them every month. Because
But when you're a young family, that is all you care about. It's like, hey, I just need a house for my family.
yeah, so that's what I mean. So then they can do it.
Ugh. There's a question here about open bidding, or just a comment. Yeah, we agree with that comment about open bidding. It is too high, easy. The blind bidding stuff is a little funky. Open
Yeah.
bidding is nicer.
Yeah, I can see the argument both ways for sure.
Yeah, I could
as the
argue it both
buyer,
ways
as the buyer,
too.
100%. But I do agree here because inside shenanigans that can't be proven, and that's the downside, because some people won't kind of manage the process with proper integrity, and then it kind of ruins the process, right?
Okay, Nick, anything else you wanted to share today?
No, I think that's it.
I think that's it. Thanks, everyone. I apologize. Yeah, Dima heard an echo. Joe, we heard an echo. We'll see what's going on with the echoes.
We'll
from
try to
this.
get that sorted out.
Thanks for hanging out live, everyone. This is the first time we tried this out like this, so thank you. Appreciate
Yeah,
it.
appreciate you guys
Have a
jumping
good
on.
day, everyone. See ya.